Welcome to the weekly update, where I'll go over the action in the market for the week of June 16th through the 20th, and we'll see how things look for the week of June 23rd through the 27th. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. Virtually an unchanged week. We were down 0.15% with the S&P. So we're holding up. We're seeing some weakness starting to come in on the daily side. We're holding up fairly well here on the weekly side, but there's some things that we want to keep an eye on for right now. Okay, let's go back over and talk about this week's session. We were down 0.15%. Now, we were above average with volume, but that pretty much was because of Friday. It was triple witching, quadruple witching, whatever you want to call it, options expiration Friday. And that brings in just this massive amount of volume into the market. Other than that, we continue to be below average with volume pretty much every day. We are still leaning more positive. Even though we're seeing some weakness and we're not trending on the daily side, we're seeing a weakening negative trend here on the weekly side, but the charts are still hanging in there for right now. We're not seeing an awful lot of weakness coming in on the weekly side, and everything has to do right now with geopolitical events. What's going on between Israel and Iran? What kind of involvement, if any, or any additional, is the U.S. going to provide Israel in that whole event? Are things going to flare up between the U.S. and Iran? I mean, we've been having trouble with each other since 1979. So this goes back quite a ways, and there's been a lot of threats and everything. And so it's a big mess. So we'll just have to see if anything develops over the weekend with that. We did have a Fed meeting this past week, but really they didn't change rates. They're just saying we're going to have to wait and see how things unfold from here. So there wasn't a lot of real direction given with that. Okay, and then we are still seeing, excuse me, a weakening trend that's negative for right now. Okay, so the Dow was unchanged. Now, we only had 4 trading days this past week. Were closed on Thursday and then resumed on Friday. We were up 0.2% with the NASDAQ, down 0.2% with the S&P, up 0.4% with the small caps. And here's some bullet points to go through. It was a shortened week, but it was also a busy week and a lot of headlines around the Israel-Iran conflict. Central bank decisions, not only in the U.S., but there are other banks that came out this past week, as well as economic data, which largely came in weaker than expected. So we were virtually unchanged. And there's a real indecision developing right now. What's the U.S. going to do? And you have the people that think we should do more than what we're doing, the people that think we should do less than what we're doing. There was some special speculation early in the week that the U.S. could get directly involved when President Trump came out and said, we want Iran to unconditionally surrender, and that his patience with Iran is wearing thin. By the end of the week, it's like, okay, we're going to think about this over the next few weeks, and I'll try to reach a decision there as to what might happen with the U.S. involvement. Okay, there were a lot of central banks that had decisions. Not only did the Fed meet, but in the Bank of Japan, they're still keeping rates at 0.5%. Now, they've been negative there for a long time, and so this is actually up from what it was, but they didn't change rates this past week. And then, as I said, the Fed met, and the current rates here in the U.S. are 4.25 to 4.5. That's not expected to change, even looking out to the next meeting or two. And I'll have the charts to show you. And the Bank of England also kept rates at 4.25%. So not a lot of surprises that way. Now, when the Fed comes out, they have this thing called SEP, S-E-P, the Summary of Economic Projections. And they did boost up inflation as measured by PCE and the core PCE. And markets didn't really like that. The unemployment rate, they pushed that up. So they're getting interest rates and inflation up a bit there. That could raise interest rates if the market's going to really see inflation. But a decrease in GDP growth and an unchanged estimate for 2 rate cuts by the end of the year. That didn't change. So there was some gyration that happened, but it wasn't really anything surprising that came out. And then the big message coming out from the press conference that Fed Chair Powell gave, we're going to wait and see, largely because the labor market is still holding up fairly well. We did get initial claims, and continuing claims are still kind of high, but the initial claims are holding up all right. Then he said he's expecting a meaningful increase in inflation in the coming months because of the tariffs. Now, there were other Fed officials that came out and said, this isn't going to be a problem. So, again, when you get two economists together, you're going to get 4 or 5 conclusions. Then the interest rates ended up going up with the 10-year yield, but we're still below the 4.5%. And then Fed Governor Waller, who does vote, he came out on Friday and said, we're not going to have any lasting tariff inflation, and that the Fed could cut rates even in July. And you've got some folks thinking that. It's not what the market's thinking. But then there was another Fed person that came out who doesn't vote. They said, well, yeah, we're kind of nervous about things right now. So just looking over the sectors. Now, I do go down through each sector later on in this video, but just to kind of go through it here, energy ended up being the most positive. Now, energy's been getting hit hard, but it's been coming back. And a lot of that has to do with the geopolitical concerns because oil has been going up. We're into the 74 range now. IT or tech was up 0.9%. Financials, we like that. We like that ratio that we've been watching on the daily side between the financials and the S&P. It's bouncing off of its 200-day moving average on the daily side. But then healthcare, that's been getting hit a lot. Communication, which is a growth area, that was down. And then materials, that's more economically driven. And discretionary still continues to lag as well. And we had some reports this week that were pretty much weaker than expected, especially retail sales. They were down 0.9%. And if you take out autos, they were down 0.3%. Okay, so I show this in every weekly video just to keep in mind we're still where the dark blue line is here, where we tend to be going lower for the most part with inflation, but that can always change going forward. And so we're always readjusting the climate just in case they do. Now, we may not play out anything similar to what this chart is saying, but we may come close to it, may even go up even more. Who knows? There's a lot of variables out there and a lot of unknowns at this point. We are still above that 4.02% level with the 10-year yield. We're at 4.38 right now. That's why you keep seeing earnings being revised down, and earnings reports are still positive, but coming down, not only currently, but looking out into the future. This was not updated. This will be updated again at the beginning of July. This also will be updated at the beginning of July, but I still like to include these charts just to see what the latest readings were. Here's some Isabel Net blog charts. This is trying to map what we're currently doing here in red with what happened at the bounce after the great financial crisis. And okay, we went up really strong there for quite a while. This also includes the COVID crash in here as well. And okay, according to whoever puts this chart together, they think that they're looking pretty similar so far. I don't know. We'll have to see how it goes. Then looking here with the risk appetite indicator, and folks were getting quite scared. Well, they're starting to at least willing to take on more risk lately as we've been bouncing up from the April lows. Then oil prices typically double ahead of recessions. Well, we'll have to see. They're up now based on this chart, so we'll have to see if they keep going up. All right, and then China has one of the lowest market cap concentration ratios globally. I don't know how they calculate this, but when you take the market cap and what you're looking at, it's not very high in China, where actually France is up there. The US is kind of about in the middle right now. And then the economy slowing since the year began. Inflation now following. Okay, we'll have to see. Looking at the reports that have been coming out, we are seeing some weakness in the overall economy, but I'm not really seeing inflation now following 3 months. Okay, this is kind of a weird chart here. I don't really see inflation being that big of a problem yet, but we always want to keep an eye open for that. And then FactSet didn't post anything this week. The person that does that must be on vacation or something. Okay, so here is the daily chart. Going back to Monday, where we had a nice strong open, and that pretty much set the high for the week, and then we just drifted down from there. So if you bought up here at about the 60-50 level, which that seems to be overhead resistance. If we hit it a week ago, and then we hit it on Monday this past week, and we can't seem to really get above that level. And so if you bought something right about up here, thinking, okay, if we hit 650, I'm going to buy, or 60-50. Well, if you bought right there, you kind of were in a defensive posture for the rest of the week. And then we gapped lower and actually went down in Tuesday's session. Then on Wednesday, we saw a strong open. Again, we set the high right after the open and then drifted down. Then this gyration that you see in here, this is when the Fed came out with their announcement. Initially positive, then negative. Then we finally broke down a little bit more negative here, and then just a lot of gyrating around. And then Friday was the options expiration day because we were closed on Thursday. So we had a higher open and then spent the rest of the day just coming down after that. All right, so looking at just going, there's 4 trading days in here, but it's a 5-day measurement. So hopefully that's not too confusing. But according to this, all of the indexes just for the 4 trading days that we had ended up being negative. If you go from Friday to Friday, some of them end up actually looking more positive, with the NASDAQ 100 actually being down the most this past week. Going back to the beginning of the year, we still have the NYSE holding up the best and small caps doing the worst, with the S&P just hanging on to a slim gain year to date. The sectors, since we had a down week, we had healthcare down the most, followed by materials, utilities, discretionary. We want that to be doing better than it is. And then energy ended up being up, and that's more defensive, but we liked that the financials did better. Tech was up. We would like communication to do even better than it has been. And then staples were virtually unchanged. We go over here and go on their scooter score from 0 to 100. Energy has been looking about the best lately, followed by tech. And then in the high 70s, we have industrials, communication, and then the mid 70s, we have utilities, where the weakest areas are discretionary and healthcare. Then looking at just the 4 trading days for the week, where healthcare, materials, and discretionary ended up being down the most. Communication was down slightly, where we had energy really coming on. And again, that's mostly driven right now anyway by geopolitical events. Year to date, discretionary is the worst performing sector, followed by healthcare. All the other sectors are up, with industrials, utilities, communication. That's a growth area. They're looking about the best. Energy is now turning positive, and the financials are positive as well. So the sectors are hanging in there for right now. All right, so an awful lot of red for the week because we ended up being down, but this is trying to go. Now this measures a week, so it's probably Friday from Friday here, but you can see Apple was up slightly, Microsoft down slightly, a lot more red, especially in the big areas like Google and Meta ended up being down for the week. Healthcare, just little patches of green here, but an awful lot of red in this chart. Then looking at the different sectors and how they are performing over the last year, we're seeing a lot of weakness, with the staples actually showing some weakness, utilities showing some weakness. They were stronger earlier on, but now they're starting to show some weakness. Real estate continues to be weak, communication weak. We are seeing tech holding up. That's the green line that's actually been showing some strength. Materials have been pulling back. We're seeing energy now turning up because of the geopolitical things, and healthcare just continues to be one of the worst performing areas. So looking at here where we have tech and industrials are still in the green, more of the yellow areas are communication, real estate, financials, staples, and utilities. Then the areas that are turning more negative, materials, energy here as well, and healthcare, with discretionary looking more blue, but lately it just hasn't been doing all that well. Then this looks at the different indexes, where we're seeing utilities, which had been strong, they've been now pulling back. And this is encouraging, and this is why we're still holding up. We see the NASDAQ 100, which is growth. It's still continuing to look okay, where the S&P 500 and S&P 100, they're yellow areas right around here, seeing more of a drawdown coming back with the Dow Jones Composite. Mid caps, transports, they're bouncing up a little bit, but still quite weak. And the mid caps are weak in the bigger picture, but have been showing a little bit of improvement. So we have the NASDAQ 100 right now that's looking a little, now this goes over the last year. So this can adjust, and it takes into account things that maybe we're not really dealing with right now that happened a while back, where the S&P 100, 500, and utilities are more in the yellow area. The composite average is red and going down, where we are seeing some improvement with the mid caps, small caps, and the transports. All right, then as far as sentiment, here we have the euphoria meter here. Has been coming back down after we were getting a really strong reading, but really didn't see much of a change in this one. We're in neutral, on the upper end of neutral right now, coming in at 55 with the fear and greed index. And we were looking quite positive here, but for the most part, we've been drifting lower as far as sentiment, but we're not really seeing a lot of negativity either. Active asset managers came in with their reading, not getting extreme there. And I'm seeing a discrepancy here. I get 82.6. This says 94.09. This has them a little bit more positive. This is another reading here. I guess 94.09 it is. So the chart that I had is a bit outdated. They have been improving, but they're not really getting extreme at this point. We're still above 20 with the VIX, both with the line chart and the bar chart. We're still going down with the black line. That's more positive for tech. So that's holding up for the time being. We did see a spike up with the right X bear bull ratio. If we have a really big down move, they go bearish. If we have a big up move, they go bullish. When this goes up, that means they're turning more negative. But this goes back to Wednesday, because we were closed on Thursday, and it's a 1 day lag, so we won't get Friday's information until after Monday. How's that for confusing? And the individual investors, after coming up in the week before and actually being slightly positive, they're back to turning a little bit more negative. The Ulster Index is declining, but still above the moving average. And we're not looking too bad here with the spread between risky, like junk bonds, and not as risky bonds, like government bonds. When this ratio is going down, that means that there's not a lot of fear. We get concerned if this really spikes up. Then on the next chart, I invert that to more match up with what the S&P is doing and what the VIX is doing as well. And we're kind of range bound with this overall measurement. So not a lot of fear there. We're still coming down with the VIX and then the 3-month average of the VIX and doing a ratio. That is more positive as this is coming down. We're continuing to decline with the long-term equity put call ratio chart. That's still positive. And doing okay, but kind of coming down a little bit with the weekly economic index as the reports have been weaker than expected. But we're still below the black line with the Chicago Financial Conditions Index. That's looking okay. Then we're going to get another look at GDP, the same GDP. This will be the third time. We've had 2 previous looks at this, coming in at about 3.5% with the latest reading, where the forecasts out there are at about 3.5% to the upside and a little bit above 0 to the downside. Here's what the GDP now looks like. So if we can actually get by with that and actually have it happen, because one of the conditions of a recession is that we have to be negative GDP for 2 quarters back to back. So to this point, it looks like we might be able to get around that. Here's the New York Fed nowcast coming in at 2.06. That's a little more positive. Now, this was updated again when we had the employment report at the beginning of the month. Still looking okay here. This hasn't been updated recently. We're below the black line with the smooth U.S. recession probabilities. Still coming down, which is positive with the Brave Butters Kelly leading index. Inflation. Now, later in the week on Friday, we're going to get PCE and core PCE coming out. That's the other big inflation gauge that is followed. And this is looking at the July 30th meeting, an 89.7% chance that rates are going to be left the same. They're at 4.25 to 5.5. That's what they're predicting, and that's where we're at right now. And the market's getting a little bit more convinced that that's likely to be what happens. Then we look out to September, and that's where you see a split. Some people think we'll see cuts, and the majority now think that there will be a rate cut. But this is going to change a whole lot between now and then. A little more conviction that they think there'll be 25 basis point cut in September, but that can change a lot. Fed balance sheet continues to decline. That's what we expect there. Year over year, we continue to go up, though, and not really seeing any problems here with the overnight reverse repurchase agreements. A week ago, I was watching this and saying, okay, let's keep an eye on that because we're worried about the financial sector underperforming. It appears that that ratio is starting to bounce back up now. So we're not really seeing any threats according to this chart. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. Looking at breadth, a little bit of weakness here, but we're still above the moving averages. So that's still positive with the advanced decline lines. Seeing a little bit of weakness here with the new highs, new lows weekly chart. We're starting to roll over and actually turn negative with the 4-week chart as well as the 10-week chart. But we're not seeing any real, it's more of a contraction of the new highs, not any real expansion of the new lows. Still above zero with the advanced decline ratio based on 19 and 39 weeks. Then here's the trend. It's a weakening trend, but it's a negative trend because the red line is above the green line. Still below zero with the Arun. We're positive on the daily side, but over here, longer term, we're more negative. And this is kind of interesting. A weekly chart mass index. If we come down and cross below the red dashed line, that would be a trigger, and it's signaling a reversal. Okay, so what we look at the context, this started to really go up about when we started to come up with stocks out of the April lows. Now, we're not going to do everything based on this one chart, but we'll see if it confirms other things. But if we do get a drop down below the red dashed line and we've been going up, that might signal that it's looking at some weakness here. Okay, then here's the daily chart. It's a little hard to see with the new pivot points for July coming in. But as I pointed out in the daily video, we've been seeing a series of higher highs and higher lows. That's a little bit threatened over the last few trading days. Now we're starting to break that pattern as we've been seeing a bit more weakness. Still above the 50-week moving average with the S&P. We're still in a downtrend, but you can see the 13-week is starting to turn back up. And we're just about ready to see a golden cross with the NASDAQ 100. And we could see one here on the S&P 500 daily chart, but we're not quite there yet. Still holding up okay with the trend channel, well above the midpoint. Now, we did have a down week, barely, but this is looking more healthy. When we see a series of higher highs and higher lows on a weekly chart, that's holding up for the time being. Now, if we fall down, we might break that pattern, but for right now, this is holding up. And then looking at accumulation distribution, we're coming down. We've actually turned negative on the daily side. We've dropped below the moving average. And the boom indicator is negative on the daily side, but it's still hanging on to being positive here. But we're negative with the Chaiken Money Flow. The histogram is going down and the red line's going down. We're declining with our third smart money indicator, the Chaiken Oscillator. We bounced up, but we're still below zero with the McClellan Oscillator. So we're declining, but still above zero with the summation index based on price and volume. We're a little bit weaker here with the bullish percent index. We've been negative. Even when we had some up days, the bullish percent index still went down on the daily side. And so after getting us really extreme positive, this is actually turning more negative currently. It's still positive because we're above 50, but the context is that we've been declining. And we're below zero and declining with the swollen trading oscillator. So that's more negative. And we're trying to turn positive here with our longer term momentum. The PMO is starting to cross up above its moving average, even though we decline based on price and volume, but we're still above zero with both. A little bit of a tick up, but we're below 50 with the PMOs that are rising. The buy signals are declining, and we're rolling over with the PMOs above zero. We're still above the midpoint with the percent B Bollinger Band measure there. And we do see an improvement with momentum, both with the two short-term oscillators, the intermediate term, and even long-term. So this could end up being positive for the market, but sometimes it takes a while for these things, especially on a weekly chart, to really change. So it's like, okay, we need other confirmation. And we're positive here on the weekly chart of the Copic curve, where we continue to be negative on the daily side. We're slightly negative with the force index on the daily chart. We dropped, but we're still positive here on the weekly side. After being extreme positive with the money flow, we are coming down, and that's an official overbought signal now. The Stochk RSI is showing longer term positive momentum, and the Williams percent are. Those are still looking quite positive there. Still above 50 with the RSI based on 14 weeks. Declining, but still above 50 with the ultimate oscillator. Positive with the vortex. The green line is above the red line. And virtually unchanged week over week there. And coming down a little bit with the 50-week rate of change, but we're still above the zero level. Positive with the special K weekly chart. Excuse me, we came down to the red line. Now the moving average is declining, but we've been able to stay above that at least for right now. And we didn't fall very much to come down and test any of this longer term support. So that's holding up for the time being. We're still positive with the Heikin-Ashi trending chart. We're positive with the Kegi chart. We're positive with the Renko chart, and we're still positive with the 3-line break chart, where we're getting a bit of a mixed to negative picture right now on the daily side. Didn't have enough of a move to draw in either X's or O's for the point and figure chart here, but the last reading was positive. So this is still holding up for right now. We are improving and coming up with the ease of movement over the last 14 weeks. We still just kind of are dancing along barely above the zero line on the daily side. And we're kind of still going up here, but leveling off with the long-term momentum, flattening out with the intermediate-term momentum, and actually declining, but still positive with the short-term momentum. We're still positive with the Elder's Impulse system, showing green bars, and we're still positive with the parabolic SAR. It did turn negative this past week on the daily side. And this hasn't changed for quite a while. On the daily side, mid caps and small caps are still negative. That's because both of those indexes are below their 200-day moving averages, where all of the other indexes are looking better. And bonds switch back to being positive in the short term. Commodities, they were big, and a lot of that's oil. And so we're seeing across the board strength there on all time frames, where the dollar continues to be weak. And okay, here is the chart that apparently I need to figure out where I'm going to put this particular chart. Okay, then looking at just the S&P here, we can see how the mid caps, we've been going up with the S&P. They've been lagging behind, as have the small caps. And in a downtrend, but above the moving averages. You're going to see that a lot in these charts here with the Dow. And same thing, downtrend above both moving averages with the NASDAQ chart. NASDAQ 100, this is still holding up. It was down 0.02%. I mean, and that's the big growth area of the market. Mid caps, you can see how they're really having a hard time getting back above their 50-week moving average. And small caps even having more trouble than that. The Wilshire, this is a daily chart, still above its 200-day moving average, and still holding up fairly well with the NYSE longer-term chart. Still holding up also with all stocks. These are U.S. and international stocks together. The FANG index just coming off of recent all-time highs and in a longer-term uptrend. We're also in an uptrend on the daily side, and these are the big stocks, so we like that they're holding up. ARK is trying to generate a longer-term uptrend. It actually bounced back up and had a pretty good week. And then we keep an eye on the banks. We're above 50 with the RSI. We've been just kind of chopping along sideways for the last number of weeks based on price, and we are improving with the momentum oscillator. Seasonality, looking at June, we've been up 80% of the time going back to the last 5 years with a return of 0.9%. And here's just looking at the Dow all by itself. It's just been chopping along sideways. The transports have been underperforming, but they've been chopping sideways recently. And we're kind of drifting sideways to higher here with the utilities. And then we saw a big move up, big in relational purposes here. We're in an uptrend with commodities, and we're above both of the moving averages. And oil is going up. That's geopolitical. As I said, we're continuing to go down here longer term, both on the daily side and here on the weekly side with the dollar index. Gold just kind of not really breaking down, but not really breaking out over the last few weeks. Silver was actually doing a lot better, but it pulled back this past week. Copper is still in an uptrend. That continues to bode well for the economy. And then we're still positive with the long-term bond ETF that we follow. And we're still looking okay with the stock-to-bond monthly ratio chart. Here's the daily chart. We're still holding up just Hey, as long as the 10-year hangs out under that 4.5%, that'll really level. That'll help things out. And then this is a weekly chart where we did see a bit of a decline with US, UK rates, also German rates down, but they've been going sideways and been coming down here with the Japanese rates as of late. Intermarket analysis chart, we still have gold. It really hasn't been performing any better. It kind of goes up and it's been range bound lately, but it's still the best performing asset in 2025. Then oil's been bouncing back up. That's the red line, followed by commodities. Then you have stocks. Then you have the price of bonds. And then the worst performing asset in 2025 so far is the dollar. Then we look at some ratios between the NASDAQ 100, which is growth, and the S&P 500, which is growth and value. This is still holding up, and we've seen a recent golden cross with this longer-term ratio. The S&P 100 is holding up when you compare it to the rest of the S&P 500, and the S&P 100 are the bigger stocks. Growth to value still holding up. That's positive. Gold to stocks just kind of chopping around lately. And then bonds continue to underperform stocks longer term. And then here's gold to the dollar. The dollar's been going down as gold's been going up, and that's why this ratio is going up. Low volatility to the S&P 500 ratio, that continues to decline, and that's positive for stocks. And then we do an energy to tech ratio. It's been bouncing back up lately, but overall, energy continues to underperform. It looked like it was breaking out when stocks were falling apart. Then we started to fall back. Now it's going back up more for geopolitical reasons. And discretionary to staples, we want this to do better. It's not really falling off a cliff, but it sure could use some improvement. And small caps continue to underperform the tech sector. Longer term, not really seeing much of a change here with the NYSE breadth thrust. We're still working off of that ZWAG NYSE breadth thrust, which was generated last April. Still holding up okay with the long-term S&P chart going back to the 1987 crash. This is that same chart. We're still above this long-term trend line. Haven't seen any changes in the Zohorchak method. We did decline from a full-on 10 all the way down to 0, but we have not dropped negative, at least yet. We're still above 0 with the 50-day moving average of the new highs minus the new lows. We're leveling out a little bit here, but we're still above 0. And then with the NYSE 50-day moving average, we're just barely starting to go positive again, and that's longer term positive there. We never did come quite up to this trend line with the NASDAQ 100 going back to 2009, so we'll see. And I drew this on here so you could probably wiggle that around a little bit and maybe make it look like it's acting as overhead resistance. But we're still looking good here. When we look at the NASDAQ 100 to Dow ratio, this is growth versus value. That's continuing to go up, so that's hanging in there. The Qs to small caps, that's continuing to be above the blue line. We're still going sideways for the most part with the 3-month yield, and we're trying to go up here with the cumulative new highs, new lows for the NASDAQ. So things aren't really falling apart, but a lot of the convicted growth upward movement that we were seeing just seems to be kind of faltering right now. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. Then seasonality for June, we're up 58% of the time with a return of 0.2%. June through November, not a really great performing time, but average percentage move is 3.4%, but we're only up about 2/3 of the time. And now we're coming into the second half of June, where typically the first half of June performs better. The second half of June is one of the worst performing times of the year, so be aware of that. And then here we see this lackluster move as we come into June, July, and August and all the vacation months. Then I know it's kind of hard to see here, but I had to do a screenshot of this. When we go from 1950 to 2024, the S&P is up 56% of the time. That's not all that great with a return of 0.2%. Then we break this out based on post-election years, and we tend to be down more than up with a negative return. And then this is also pointing out that things might turn a bit lackluster over the summer months as far as volume, both on the NYSE and here on the NASDAQ as well. Thank you. I hope you're having a wonderful weekend, and I will talk to you in the next video.